What's going on, everyone? My name is Jeff. So what I've done, guys, I've put a list together of 3 restaurant stocks that I feel are not only very undervalued, but I also feel like they would perform well during a recession. So you got to kind of be careful with that. Sometimes you think what restaurant stocks are the absolute best, and sometimes the companies that are the best and the biggest also have the most room to fall in a market correction or a stock market crash. So I've really pinpointed some smaller market cap restaurants that have some real growth potential, some real momentum, like I said, solid fundamentals, and also with the looming threat of a failing economy or a recession, I feel as though these stocks would hold their value well. During a recession, all stocks are going to get hit. Nothing is truly recession proof, okay? It's just that the companies that are most overvalued and have the most debt are going to get hit the hardest, and the companies that have the most solid fundamentals, significantly more cash than debt, tend to hold their value a little bit better. But and there's no such thing as a recession proof anything, okay? Guys, if you're new to the channel, make sure to hit the subscribe button so you don't miss any future content or update videos. And if you enjoyed this video, feel free to drop a thumbs up on it. Now let's get started. So the first restaurant we're going to talk about, guys, is Domino's Pizza, ticker symbol DPZ. Now don't pay as much attention to the stock price. What I want you to look at right here is the market cap, $10.9 billion, and Domino's is growing leaps and bounds, one of the highest growing stocks over the past 5 years. As this little chart shows you right here, in 2014, Domino's was trading around $73, and it has tripled its share price since then. Now, here's my real thing about Domino's. Guys, they're very, very undervalued. The growth potential is still there. And like I said, with a $10 billion market cap, let's face it, if a recession or a market correction was to come, people are not going to stop ordering pizza, right? And especially cheap pizza and meal deals and, of course, pasta and brownies and all the stuff they have on their menu. Like I said, me and my family, we can go eat there and bring stuff home for 30 bucks, and everybody has stuff left over to eat the next day. And so those kind of meal deals and those kind of discount packages will actually probably go up quite a bit. Now, I'm not going to go as far as saying that Domino's would boom through a recession. They would still see steady business. I think their earnings would still come in a lot better than other companies, and I also think they could strategically adjust to prices a lot more naturally than, let's say, a Chipotle Mexican Grill or a Starbucks, or maybe some of the bigger restaurant chains like a Longhorn Steakhouse or an Olive Garden, okay? Keep in mind, it does pay about a 1% dividend on top of the huge growth, and it's their 41% return on assets, and of course being positive in both profit and operating margin, and just the sheer growth, guys. There's Domino's going up everywhere. I think Domino's is a buy now, and I would not sell in a recession. I would probably end up buying more. Alright, guys, and at number 2 is Wendys, ticker symbol WEN. Now, I'm sure you are all thinking, oh, this guy, he is just picking restaurants that make cheap food and putting them on this list. And guys, no, I am actually invested in both of these companies that I've already mentioned. And these are both positions I have as a preparation to a recession. Like I said, again, same story with Wendys. If a recession was to happen, you know, cheaper level fast food is probably going to continue to grow, and I think they can still put out decent earnings. And like I said, the big thing is that they can adjust their prices kind of naturally, even if it comes down to lowering their prices, but still remain very competitive with their global reach. Wendys pays about a 2.23% dividend, and this stock has grown well over 100% over the past 5 years. But that doesn't really tell the whole story of Wendys, guys, because back in the 90s and the late 2000s, Wendys was actually a lot bigger company that lost a lot of market space to other restaurants and now is making a comeback. So it has a $4.23 billion market cap. I feel like it's very undervalued, and I also feel like they will survive a recession very, very easily. Wendys does have a trailing PE ratio of 9.78 and a forward PE ratio of 24.2. Now, I usually do not go off PE ratios. In my opinion, for a company that has had this much growth over the past 5 years, that is a very, very reasonable trailing and forward PE ratio. And also, guys, the PEG ratio, that is 2.85, also a very, very good metric. So if you do not have Wendys in your portfolio, keep in mind it's only $18 a share, and it would be very easy to make room for a position. top. Sorry guys, McDonald's and Starbucks is not on this list. I do think McDonald's and Starbucks will perform well and relatively hold their value, but I think those are companies you would actually be better served to buy, once you feel the bottom has set in during a recession. Like I said, with Starbucks, I feel like that could be very easily cut out of your budget. If jobs started tightening up and money got tight, that $12 cup of coffee could probably be one of the first things to go. And even with McDonald's, I think McDonald's will do fantastic during a recession, but I also feel like McDonald's has gotten so big, and being a mega cap company, there is pretty much only one direction to go when the markets start to tank, and that is down, okay? So the last company we're going to talk about, guys, is Denny's, ticker symbol DENN. Now trust me, I would probably not be caught dead eating in a Denny's. I can wholeheartedly tell you I am not a fan of the food at all, but the stock is a different story. I do not own a position in Denny's, but I have thought about it quite a bit. And guys, 5 years ago, Denny's was trading at $6.50, and it is approaching close to a 200% return since that time. And at a $1.09 billion market cap, Denny's is still very undervalued at these levels. And like I said, very, very reasonable fundamentals, because they do have almost 7% of a profit margin, little over 12% operating margin, and then a 14% return on assets. And we can look at their short percent of shares outstanding, and that is roughly 5.8%. Now that is a little higher than what I usually like to invest in, but keep in mind, on a good earnings report, these kind of stocks with a lot of short shareholders can tend to spike a little higher, creating a short squeeze. So the shorts have got to get out of that position if and when Denny's has good earnings. But don't just take it from me. Denny's recently, at the first week of April, just got an initiated buy rating. Maxim Group rated them a buy back at the end of December. And of course, Stephens & Company upgraded Denny's from equal weight to overweight back in October, and the stock has performed excellent ever since that time. But anyways, guys, that's all I got for the video. Make sure to drop a thumbs up on it. If you enjoyed it, drop me a comment. Tell me some companies you think would be very strong during a recession. I would love to hear some of your ideas. As always, thank you so much for watching, and have a great day.